Let me start. So I think we are recording now. So today's lesson, we are going to deal with margin trading. So I believe most of you have come across a margin, or basically the account. So that's what I'll be handling today. So give me a minute. I share my screen. 1 minute. So okay, great. I'm seeing at least we are a couple number of us, so we can get started immediately. So today we'll be dealing with margin trading. I won't take much time, so maybe an hour or less, because the other class we already tackled with them the same. So I wanted we tackle margin trading, so that next week we begin with analysis, or technical, fundamental, and sentiment analysis. Yeah, so today we'll be talking on margin trading. So as you can see on my screen, so this is the account running. So I'm seeing I'm on making some good progress. As you can see, we are already running on 356 USD, which is okay, or 355. So this is what I'll be handling. This is margin level. You can see this is free margin. This is margin. This margin now 161. And then we also have equity and balance. So mostly this is what I'll be tackling about. Then maybe we'll check a little bit of analysis on what this week is all about, or what is happening. So give me a minute. Let me open up my, just a minute. I admit more guys. Okay, welcome guys who are coming in, welcome. So just give me a minute. I need to get some information here. So you can also sign up on Baby Pips. Okay, welcome guys, the new guys, welcome. Sorry. So 1 minute. So that we sign up on where the information is here. So today mainly we'll be dealing with margin trading, understanding your account risk. Basically, what are you supposed to do? How much risk are you supposed to take in that account? $100, $200, $300, $500. So basically, just a minute. So let me use my syllabus, what I usually use, so to understand margin. So these are just some of the terms we usually use. The forex market comes with very good set of terms and jargon. So these are some of the terminology, like cross rate. Cross rate, basically the currency. Let me add volume for guys who are not hearing. Okay, that's okay. So for example, so this is a cross rate, the currency exchange rate between two currencies, both of which are not of the official currencies of the country in which the exchange rate code is given. This phrase is also sometimes used to refer to currency quotes which do not involve the US dollar. So then regardless of which country the quote is provided in. For example, if an exchange rate is between the pound and yen, quoted in American paper, this could be considered as the cross rate. Basically, the rates, basically you usually have even USD KS, USD Euro, or Euro USD as the rate. Then you usually have the exchange rate now, the value of one currency that is expressed to another. For example, if the Euro USD is 1.3200, 1 euro is worth one euro is worth US dollar 1.3200. Then the PIP is the smallest increment of price movement. So mostly our business deals with pips. Basically, when you hear us talking about pips, basically is what is converted to become as money. So the smallest increment of price movement a currency can make, also called point or points. For example, 1 pip for the Euro USD is 0.0001 and 1 pip for yen is 0.01. So yen is usually quoted to 2 decimal places, where the rest they are quoted for 4 to 5 decimal places. Then we'll have something called leverage. So leverage, when you go to brokers, you are basically opening an account. There's a place you'll see written 1:10 or 1:100, 1 is to the ratio of 200. Others go up to 1:500. So when it comes to leverage, so leverage now, when you put in your account to work, you will be asked to use leverage. So leverage basically is, say you're given leverage 1:10. So if you're given leverage 1:10, that means you're being given 10 times you deposit. So if you're depositing, say for example, 300 or 400, $500, and you have leverage 1:10, that means you're getting 10 times whatever you're depositing. So if you're depositing $1,000 and you're getting leverage 1:200 or 1:100, that means you're getting 100 times. So this is one of the most important things that makes Forex very attractive in the business. So leverage 1:100, 1:200 is 100 times or 200 times what you have on the account. So if you're putting 1,000, you just do 10 or 20 times, depending on the leverage. So leverage is a double-edged sword. I need you to remember that. If you use it to the wrong way, because there are guys who risk too much. So if you risk too much, then, or you over leverage your account, in other words, that means you might end up losing that account, or you might end up losing all your capital, which is not good. So leverage is a double-edged sword. So it's good you use it to the right way. So if you have leverage, say 1:500, that means you can trade more than up to 500 times whatever you're having on your account. But that does not mean you misuse that leverage, because if you misuse that leverage, then that means you might lose all your capital, which is not good. So leverage is the ability to gear up your account. Okay, I'm seeing there's a question. You can always drop me that message down there so that I can be able to, I can be able to, to respond down here. So we are talking on leverage. So just drop me a message kindly as we continue because of time. So for instance, if you have $1,000 of margin trading and you open 100,000 USD, this is an example, for example. So position, his leverage, or the leverage of this account is 100 times, or leverage 1. You can see, for example, here, leverage 100:1. So I'll need you to really understand this. It's very important, because if you understand leverage and margin, it's very, very hard to lose an account, because you only need to understand how basically the account works, or the lot size and the risk management. This is where everything comes in if you understand margin. So we were at 100. So leverage here is 100 times, or 100:1. If you open if he opens 200,000 position with $1,000 of margin, then the leverage will be 200 times, or 200:1. So increasing your leverage magnifies both gains and losses. So it's good to know that. And then just a minute. To calculate the leverage, use divide the total value of your open positions by the total margin balance in your account. For example, if you have $10,000 of margin in your account and you open one standard lot, say for example of USD and 100,000 units of the base currency, for 100,000, your leverage is 10:1. So if you open one standard lot of Euro USD 150,000, that is 100,000 times Euro 1.500, your leverage will be 15:1. So anyway, I'll explain later practically. Let me first go through the theory of what is margin. So this is the definition of what is margin. So the deposit required, or basically margin, is the deposit required to open or maintain a position. So margin is the deposit required to open or maintain a position. For example, these are positions running. I hope you can see. Let me minimize the screen. So these are positions running. Some are in profit, some are in negative, but I'm saying most of them are in profit. And I'm seeing gold is almost at 250 USD. You can see the lot size here. I used 0.05 on all the pairs, depending with whatever I'm trading. I'm using 0.05. So I have one. Let's see how many positions I have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, almost 16. But you can realize I have used a very small lot size. This is an account of roughly 5,000 USD. So basically you can see the size or whatever I've used on the size is 0.05. So you can see my margin is still big. You can see my margin level is 3,000. So margin, basically what I'm trying to say is whatever you can see as these trades are running, the margin is required for these trades to run. For every time you open a trade, whether you're buying or you're selling in the market, whatever you're doing in the market. So there is required margin. There's something usually called required margin. So required margin is what you use, or is what that is used to be able to maintain these positions running. The way you're seeing these positions running, that is required margin. But we are going to go into detail. So basically margin is the deposit that is required to maintain and to run these positions, as you can see them. So minute, okay, let's continue. So that is what margin is all about. So margin is the deposit required to maintain, to open or maintain those positions. So it can either be free or it's used. So I want you to understand it can either be free or used. Used margin, for example, let me give an example. Used margin is the amount which is being used to maintain an open everything is good. Everything is good. I hope you guys can hear me. So let's continue on margin. So we are saying margin is the deposit required to open or maintain a position. So margin, it can either be free. So we have more guys coming in. Welcome. Continue. Okay. A minute. Roger is waiting. Okay, let's continue. Sorry. So as I was saying, margin is the deposit required to open or maintain a position. It can either be free or used. Used margin is the amount which is being used to maintain an open position. So that's what I was talking about. So used margin. So let's go back to our chart. You can see the trades running. So used margin, we cannot be able to see it. But for these trades to keep running, or for these positions to keep running, no matter how many they are, they require margin. So the more you open a trade, or the more you keep adding up a trade, you realize this margin will go up or down. We are going to do an example, but let me first explain comprehensively about margin. So margin, used margin, is that amount which is being used to maintain an open position. Whereas free margin is the amount available to open new positions. So for me to know how much I have or how much margin I have left, this is what I'll do. I'll go to free margin. Free margin is this one. I hope you can see. Free margin is this one. Let me add volume so that at least you can all hear me. Sorry, it's here. I think that's okay. So you can see free margin down here. I hope you can see this free margin 51.96. It keeps running because I have trades that are running. So free margin now is what is available, or if I want, or I have found an opportunity in the market to get in. So free margin is what I'll be looking at. This free margin is how much I have available to open new positions. I hope you guys are following. Okay, raise the hand. Okay, a minute, let me chat. So a minute, guys, let me put it here. Hello. So you can chat me, I can hear you out loud. I hope you all can hear me. So you can ask questions, it's live as I continue. So it's a very, very important lesson. So just follow, well, because I'll show you practically. So we are saying used margin is that amount which is being used to maintain an open position, whereas free margin is the amount available to open new positions. I hope you are clear on that. So free margin is what we have to open, what is available to open your position, while used is the amount that is being used to maintain the open positions. Then, for example, if you have 1,000 margin balance in the account and 1% margin requirement to open a position, you can buy or sell. You can buy or sell a position with up to a notional of $100,000. This allows a trader to leverage his account up to 100 times. So one lot, let me show you. This is one lot. This volume here, this is one lot. Is usually equivalent to 100,000 units or 100,000 contracts. So this is basically one lot. So let's go back to our definition. So this allows a trader to leverage his account by up to 100 times. So this is the leverage. So leverage is basically the deposit once is how much you're given by the broker. So if you have a 1:100 is 100 times whatever balance or whatever deposit you put in. So if a trader's account falls below, I hear you from my end, and my volume is maximum. Okay, good. So if a trader's account falls below the minimum amount, so now if the margin is going down, this is what happens. Required to maintain that position, he will receive a margin call. So margin call now is the broker telling you, yo, things are not working very well. You need to close up some position, or they are automatically closed in case you've used too much margin. This usually happens in the case scenario whereby you have leverage or you have used too much margin. Say I have 1,000 USD and I put lot one, or even 2,000 or $3,000. You're using too much margin. And in case the market goes against you or the market doesn't favor you that day, you might receive a margin call. So a margin call basically requiring you, okay, Joe, welcome, Joe. So basically you receive a margin call requiring him to either add more money, so you either add more money into his or her account, or to close the open position. So once you close that position, you free up the margin. You free up means you have free margin. So the used margin that was locked up is freed up. That means we have more margin in the account to be able to run or open either new more trades. So margin you need to understand very well. So another thing, most brokers will automatically close a trade when the margin balance falls below the amount required to keep it open. The amount required to maintain an open position is dependent on the broker and could be 50% of the original margin required to open that trade. So I think they did not explain further much. So I'm going to use this site. It's called BabyPips. It's usually good for learning for the new guys. So let me give you the definitions and then also show you practically on margin. So give me a minute. Okay, 1 minute. So I hope you're following. You can ask questions. Then after margin, we'll just look at a retro of what was happening for this week. That means on a little fundamentals, a little technicals, and then it's up here. Or this one, margin 101, margin trading 101. Chris, welcome. Still following. So I'm just going directly to go to the definitions because we have practicals to have a look at. So let me just go to the cheat sheet down here, or the main definitions. So they're here. So now follow keenly, because at least this website is able to explain margin very, very well. So here's the so as you dive in the world of margin, it seems like telling your language. So these are the definitions. So just follow. So this is margin, the amount of money you're required to deposit. So anytime you deposit money in your account for trading, basically that is where margin comes in your trading platform. In order to maintain positions in the forex market, it is used as collateral to ensure that you can cover any losses you might incur. So same case with the leverage. So if you have 100 or 200 times whatever leverage, guys, kindly mute your your end. So margin is the amount required to deposit. You're required to deposit. Then leverage, the ability to trade larger amount with a much smaller amount in your account. So this is basically definition of leverage. It's the ability to trade a large amount with a smaller amount in your account. So that's why I was saying, if you have $500 or $1,000 and you have leverage 1:100, you have 100 times more. Then we have unrealized P&L. So unrealized P&L is the current profit or loss that is held. So whatever is running here, you can see this is unrealized P&L. Whatever you're seeing running here, this is unrealized P&L. You can see all these. So unrealized because they have not closed. They are just running. So and if they are running, they are unrealized. If we close them, now they become realized. So let me go back. So that's unrealized P&L. It's also called floating. So if you hear something like floating P&L, basically the trades are running positive or negative and they have not been closed. Then we have the actual balance, whatever you deposit in your account, the total amount of cash you have in your trading account. If you have an open position, even if it has a floating P&L, your balance still remains the same. So the balance is never affected. So that's the account balance. So let me show you. This is the account balance. You can see down here, 4975.55. This is the account balance we are talking about. You can see it does not change. It does not change as you open or close. But if you close in a profit, it's added up. If you close at a loss, of course, it's deducted from the balance. Then we go now to margin requirement, the percentage level. This is important to note. For the margin requirement, it's the amount of margin required to open a position. It is expressed as a percentage. You can see it down here, this percentage, this one, that mine is reading 32, 92, and you can see it keeps changing. It keeps moving depending with the P&L or the floating profits or losses. So it keeps changing this percentage. This is very, very important. So, and we are going to see how it affects the account. It is expressed as a percentage of the full position size or notional value of the position that you wish to open. So required margin is the money that is set aside. This is what I had talked about this earlier. Required margin is the amount that is set aside or locked up. So when you open a trade, there is required margin to maintain that position. For that position to keep running, there's a required margin that is needed there. So for example, if you open a 10,000 mini lot position with required margin of 2%, leverage is 50:1, $200 will be locked up. So you can see that was 2%, 2% risk. So 200 will be locked up during the duration. Until you close that trade, that's when the $200 will be freed up back to become free margin. So this 200 can be used. So it cannot completely be used to open another position as long as the trade is open. And once you close the trade, the $200 margin will be released. So this required margin. It's also called initial entry margin or maintenance margin required.
Excuse me, Kamau.
Yeah.
Hey,
I can hear you, Joe.
Do you really need to, like, remember all those terms? Like I'm seeing so many terms here.
No, not really.
You just get the concept.
Yeah, just get the concept, because the main idea is we'll go to the practical. I'll do a practical application on margin. So just understand, just follow through. Then, but when we come to the real account or whatever, when you're trading, it's very important for you to remember. I hope
Oh,
yeah, I hope you are together. Especially
yeah.
you understanding what is equity, this margin, and this free margin, and this margin. I hope you can see this margin percentage. They're very important
Yeah.
because if you understand how they operate, it is very, very hard to lose an account, or it's very, very hard just to blow up. Because the idea with margin, mostly it's tied up to risk management. If you're putting a new order and you're risking higher, so like for example,
Oh,
if you have $1,000 and you're
yeah.
risking more, because risking lot one, that is like you're risking almost 50 or 100%. But if you're risking,
Yeah.
say, 0.01 or 0.02 or 0.03, that means you're only
Mm.
risking 2 or 3% of that account for every trade. So for every trade to happen, you need to understand how much risk you're putting versus how much reward you need. I hope you're following. So,
Yeah.
and that's why I was putting an example with, I have almost 17 or 10 trades running, and you can see I've only used 0.005 with an example of a 5,000 USD account, it's at 49.75. And then that's why you can be able to see this margin percentage. At least it should not go below 1,000%, or on a worst case scenario, 500%. If you are a very aggressive trader, or you're very, very, maybe you have the high risk appetite. I hope you're following. So
Yeah.
now, yeah, let me finish. Let me finish on margin, on explanation. Then now we go to a little bit of the practicals before we call it a day. So these ones you don't need to know so much. I'm just giving the definitions. Just understand the definition of what is margin, free margin, required margin, and used margin. There are around 3 or 4 of them. So now this is used margin. It's the minimum amount of equity that must be maintained. So this is also important, that it's the minimum. So for every account you're trading, you need to always know how much minimum equity. So if you're risking, say, 5% or 3 or 4, I would suggest you start with 1, 2, 3. Maximum you can go beyond 4%. For every trade, you need to know how much minimum equity should be running on the account. So say, for example, I'm running at a loss of 100 minus $100, and maybe I had 500 or $1,000. I should always know the minimum amount of how much loss or how far would you be willing to go to take the loss or whatever in the account. So used margin is the minimum amount of equity that must be maintained in a margin account. This is the total amount of margin currently in use to open all positions. So if you open many positions, say even if you have 10,000 USD and you open so many positions, there's always margin that is required to maintain or run those positions. So unused margin is all of those combined, all those margin that are running on that account that is used. So this is the most important, because you need to be able to always see, and you'll be able to see it through this percentage and also through this free margin. So because it's usually concurrent with how much balance you have and how much equity is running on the account. So it's good to always know how much risk are you willing to put, or how much risk are you willing to put out there in the market, or how much are you willing to risk to be able to get your reward in the market. So that is used margin. It's also called maintenance, used margin, and maintenance. This is how you calculate it. Total required margin. So basically, you can see it here. It's total required margin for all the open positions. I hope that is clear. Then equity is also important. I think equity, you can see it running here. Hope you can see equity here, 5286. That is your equity. So what is equity? So equity represents the real account value. If I need to know how is your account doing current, even if you are running at a loss or at a profit. So equity is your account balance plus the floating profit or loss of all your open positions. So it represents the real-time value of your account. So if I really need to know how your account is doing, or the value of your account, or is it doing very well or bad, we'll just look at the equity here. So as at the moment, my equity here is reading at 5280, and you can see the balance is 4975. The free margin is 51 something. So that means the more I keep running at a profit plus whatever I have. So basically, equity is the floating profit plus whatever I'm having on the balance. So if the balance is 49.75, you add up the floating profit or loss here. So that is what you get as your equity. So you can see it's higher it's higher than the balance, because basically we add balance plus whatever is running as a floating profit or loss. So basically it's also known as account equity, net asset value. It depends whether you're trading currencies, stocks, whichever account you're having, but equity still remains the same. It's net asset value or net equity. So basically, here is how you calculate it. Equity is equal to balance plus the floating profit or loss. If you don't have any open positions, the equity basically is equal to what the balance is reading in the account. Now we go free margin. So free margin is the amount that is not locked up. So this one is free, as the word says, it's free. Is not locked up due to an open position and can be used to open new positions. So when this value is at 0 or less, the margin warning is triggered and additional positions cannot be opened. So I need you to understand this. This is very important, so that when the value is at 0 or less, the margin warning is triggered and additional positions can't be opened. Free margin, you will always see it here. I think you can see my free margin is here around 50, 90 something. It's running here. So if this value is at 0 or less, now that means our account is not doing very well. You get an email alert or an SMS, or the broker will call you to tell you your trades are not doing well, your account is not doing, and some of the additional positions will start being closed automatically. Why? So that we can free up margin, because the margin that was there was used up, all of it. So it's also called free margin, available margin, usable margin, or usable maintenance margin. So free margin is equals to the equity minus the used margin. And then we have the margin level. Now that's the percentage, is the ratio between equity and used margin. So for us to understand the equity and how much margin we are using, that's where the percentage comes in. This percentage I was telling you about. For us to understand, we need to understand the margin level. So it's the ratio basically between the equity and all the used margin in there, all the current positions that are running in the account. Each and every position has required margin. All of them combined, we have used margin. That used margin, now the ratio between equity and the used margin, that's where we get the margin level. So for example, if your equity is 5,000 and used margin is 1,000, then the margin level is at 500%. That's just an example. That means you've already have a risk of almost 20% of the accounts. It's also called margin indicator. How do you calculate it? Is equity divided by used margin times 100%. Then we have margin call. Now this is specific level. If your margin is breached or level equal or below it, you won't be able to open new positions. I believe most have an idea what a margin call is. If the margin call is 100%, this means that if your margin level reaches 100%, you won't be able to open any position. At this point, your account is now under a margin call. And I had told, so even though most new traders assume this, trades will be closed, a margin call is just a warning. It's just telling you, you usually mostly get an email telling you, hey, you have opened too many positions. You need to close some positions to free up margin. It's also called minimum margin requirement or minimum required margin. Then we have stop out. Some trades, you will see once you close the history, stop out. You'll see a name written there. What is that stop out? Stop out basically is a specific level where the margin level is equal or below it, your broker will automatically start closing your positions until the margin is greater than the stop out level. So the margin has to go back to where it's supposed to be. For example, let's say the stop out level is at 50%. This means that if the margin level falls below 50%, a stop out will automatically occur and the position floating the largest loss will be liquidated. So say, for example, we have $5,000 or 10,000 and you have minus 1,000, minus 500, minus 300, minus 100. If the margin is used up too much and then things are not working very well in the account, the first position to be closed with the highest loss, for example, was the minus 500 or minus 800. That one is the for one that will first be closed. Why? Because we need to free up margin to keep the other positions running, whether they are running at a profit or whether they are running at a loss. So this means that if the margin level falls below 50%, a stop out will automatically occur and the position floating the largest loss will be liquidated automatically. So this process will be repeated until the margin level increases to a level at least above 50%. It's also called liquidation, margin closed, margin close. So we also need to go to margin call. It occurs when, of course, you have breached the margin call level. Now, that's where the free margin falls below zero or anything below that, but still above the stop loss. So a margin call, it's a warning. The broker is, or basically your account is not doing well, telling you that your account isn't doing too well and that you are close to having your open positions liquidated at market price. So that is margin call. So then we have stop out. It happens once the stop out level has been reached, is when your open positions will be automatically closed or liquidated to provide a negative balance. So how will you avoid a margin call? Let's see how you avoid a margin call. Then now we go to the charts. So trading on margin is a way of traders with limited capital to make significant profits or losses. So understanding what margin is and how it works is the first step in knowing how to avoid one. So as you begin your trading journey, this will be the first thing to avoid this case scenario at all costs, because if it hits you, most likely the account might go or the whole capital might go. So most traders want to focus on other details of technical indicators, chart patterns, but they don't give attention to these elements of what is margin requirement, whatever we have gone through, the percentage, equity, used margin, free margin, and margin levels. So I hope now you understand. So if you're trading an account, I think we are done for this, so that we go to the, so you can always trail or scale your positions. Scaling in is getting in and out of a losing trade or a profitable trade or a losing trade. But these ones I'll show you later. So remind me to show you scaling out. So how do you avoid margin call? You can either trail your stop loss, or you can also you can use a stop loss. You can use a trailing stop. That's another thing you can do. Just a minute. What else can you do? You can also scale in positions rather than entering all at once. So this is, let me give you a good example. Say I have $1,000 and I get a position of euro, dollar, or USDA. Instead of entering with 0.1, why don't you reduce it to 0.01? Then start scaling in. If the trend keeps going to your direction, you can now keep adding up your position, 0.01, 0.01, or 0.01, 0.02. Basically, you're compounding or you're making more. So that is what scaling in and scaling out is all about. Then use stop loss orders or trailing stop. This one I'm going to show you. I think we even had done last time. So right now, let me go to the charts so that at least we have a look at what has been happening this week. First of all, I had told you, apart from, I think, do we have any questions on margin? Anyone on margin level or free margin? You can raise your hand or you can chat me here on the side as I continue. So we had said last time, it's always good to always know what is happening. And we had said it's always good to have your economic calendar with you. So let's see what has been up this week on our calendar. Always have this calendar with you. I have Forex Factory, and I also have this one called investing.com. You can use any of them. You can also have your Twitter with you to always follow these. There is also Bloomberg. I had told you about Bloomberg. They also have an app. I think it should be compatible both with Android or iOS, depending on what you're using. So I'm just going to use both the investing and also, or let me just use the Forex Factory, because I'm only interested as at the moment with the economic calendar. Economic calendar basically is to know what has been up. So I think from Monday this week. Yeah. So from Monday this week, I'm not seeing, we had this ISM manufacturing. So I'm just going to explain what this is under fundamentals, because next week we'll be introducing the technical analysis, fundamentals, and the rest. So a minute. Yeah, that's okay. So this is ISM and manufacturing, or basically ISM and manufacturing PMI, producers manufacturers index. So basically is, for example, if you have a company, say maybe pipes or cement or anything, any manufacturing company you know. So this manufacturing PMI basically gauges how much orders do you have, how much production do you have, how much profit have you made. That is in total percentage. So basically that's what ISM non-manufacturing PMI is all about. So we are asking how much orders to your clients do you have? How much production? In terms of production, how much are you producing? And also, apart after you producing, how much are you making? That can be quarterly or yearly or monthly, depending. So, but at least on a daily basis, of course, you keep records with how much orders and production, and of course, how much at the end of the day profit you'll be making. So basically, that's what ISM non-manufacturing PMI is, and you can see it came out positive. Minute. So the previous was 46.7, the forecast was 47.0. No, it was 45.4, 50, and then the actual was 57.1. So basically, ISM manufacturing, that is what it's all about. Then that was Monday on 6th, and then we have Tuesday. Today we had cash rate or RMBA statement. Basically, it's the interest rates for Audi or AUSI, the Australian dollar currency. Okay, my light is back. Okay, so that was what happened on Tuesday. So they cut the interest rates. We'll be handling interest rates at a depth when we are trading, because interest rates basically they are what that governs the forex market. That's very important. So COVID happened. That's why we also having the Zoom meeting, because most guys can also not make it to come for the physical class. But when the COVID happened, I think early February. Yeah, welcome, Maureen. Seeing we are still having more guys coming in. Welcome. So when COVID happened early, it started in December in China, 31st. That's when the outbreak happened. And then February was the peak, in March. When that happened, economies were shut down. We went on lockdown. And when we went on lockdown, most, actually all, let me check for you down here, but I'm seeing like all the main guys, you can see the interest rates are here, just beside here. So you can see, for example, Audi here, they cut the interest rates with minus 0.25%. That was on March 19th. And then you can also see on the card, they also cut, I also think they cut with a BP of negative 0.50%. That was on March 27. So I think most of them followed suit. New Zealand, the New Zealand Central Bank, they also cut with minus 0.75%. That was also on March. So you can see the big blow was on March. The dollar also, they cut to up to zero. You see the dollar, actually they cut more, minus 1.00%. So I think the interest rate right now, they stand at almost near 0%. This also encourages businesses, because now they can borrow more, they can be able to produce more, because technically the interest rates are very low. They cut these interest rates because there was a big economic fallout because of the pandemic. The pound also they cut, I think minus 0.1%. The only one that euro remained the same. The reason why euro remained the same, you can see it's unchanged on June 4th. So euro is the biggest economic bloc, or the biggest market in the world is usually the euro, or the eurozone area. So they didn't, because the reason why they didn't, at least most of the European countries were able to handle the virus very quickly. Germany, France, Switzerland, Sweden, and all those other countries. So the euro also, they did not want to break the euro, because the euro is very, very strong in terms of business, in terms of value, and in terms of return. So then the main safe havens, or why JPY and CHF, that is the yen and the Swiss franc, you can see they were unchanged on May 22nd. And also and you can see they usually trade, or basically the interest rates are usually at a negative 0.1%. And then for CHF, or the Swiss franc, it's usually negative 0.7%. You can see also it was unchanged. The reason it was unchanged is people banked on the dollar, because the dollar now is where basically was the reserve. It's like you're holding your money in the bank. So That is where. Then now for Japan and for the Swiss franc, those now they were acting as the safe haven. So most of the movements, just check your CHF and the JPY pair, and then you'll be able to see. Let me give you a look at it, at how it looks like here, the chart, so that at least you can be able, I can be able to explain to you what was happening. So let me add up. How do I add it up? I think I can add it up here. So when I'm seeing the dollar has really lost, so we're also going to see why the dollar has lost. This is USD CAD, and also this is USD chef. Welcome, Leonard. Welcome. Still continuing. So let me add up CHF and JPY. Oh, it's right here. CHF and JPY. So that we can be able to see at least since March, because March is when I'm seeing most of these big movements were happening. What was happening? So this is CHF. So I'm seeing CHF has been winning. So you can see, but now I want you to see at the movement. The movement is they go up, they come down. They go up, they come down. They go up a little bit. It's an uptrend, but is not a definite uptrend. It looks like that. This is on H1. So on March, let me use the H4, and then we can be able to see what happened. So this is, yeah, this is H4. So this was on since February. So this was January, and then this was, yeah, this was 2nd January 2020. I think it was immediately after New Year's Eve. So you can see CHF dropped, or the yen, the franc lost, and then it gained, and then around this is still January, dropped again, and then there was consolidation here, came down again, then came up again. So I want us to go to March, at least March or February 20th. So around this area, yeah, this was 22nd. So you can see a lot of movement. Look at around this area. This was when? This was March now. You can see around March, there was a big move going down, then a big move up, then a big move down, then a big move up. So you can see it's like a zigzag kind of pattern. You can see then it reached its peak around 25th March, then dropped again. It came to a low. Well, this was a lower low. That was in 2nd March, April. Then came up back again, then went down. So you can see how this pattern looks like. It looks like it's going up, then coming down, going up, coming down, going up, coming down, going up, coming down. So it reaches then its lowest. The lowest peak was on 7th, then starts coming up, going up. So as the trend is going up, it doesn't just go up, it goes like it's forming those highs and lows as it keeps going up. So this is where the main activity was happening, or basically most of the currencies or the safe havens were being backed here. So another safe haven that we were looking at, or that has been really rewarding, of course, has been the gold. So gold, you can see it has been on its all-time high. So the reason why most investors also backed gold is because gold is usually the ultimate form of monetary value. Most of these currencies, they should be backed by gold. If we go back to our history, let me give you guys a little bit of history so that we see what really happened this year. So just a minute. Sorry. So let me show you what really happened, so that at least you can be able to have an idea of what really happened. So I'll just go to the history. The history is on the first pages, so that you can be able to know why gold has been really going up. So just 1 minute. So let me go back to my curriculum here and show you a little bit of history. Let's just go to Forex before and Forex right now. Yeah, it's around here. So a brief history of the Forex market. Okay, I admit it's going to be a little boring, but it's important to know, to have some basic knowledge of the history of the Forex market, so that you know a little bit about why it exists and why it got here. So just follow through. It's just a few minutes. some basic knowledge. So this is the history in a nutshell. So in 1876, something called the gold standard was established or was implemented. I think that was almost 140 or 44 years ago. So basically it said that all paper currency had to be backed by solid gold. Now you can see it had to be backed by solid gold. The idea was to stabilize the world currencies by pegging them to the price of gold. So basically all paper currency peg them to the price of gold. The idea was, so it was good in theory, but in reality, it created boom bust patterns, which ultimately led to the demise or the end of the gold standard. Why? Because gold was dropped around the beginning of World War II as major European countries did not have enough gold. Now the problem was the supply of gold is very, very low. Like basically, we could not be able to, it's always scarce. Gold is very scarce. It's very, very hard to come across gold. And that's why it always maintains its intrinsic value. So it was dropped. The gold standard was dropped around the beginning of World War II as major European countries did not have enough gold to support all the currency they were printing to pay for the large military projects. There was a lot of war then. Although the gold standard was ultimately dropped, the precious metal has never lost its spot value as the ultimate form of monetary value. So you can see why I was telling you, gold has always maintained to be the ultimate form of monetary value. So the world then decided to have a fixed exchange rate. So they decided to have fixed exchange rates that resulted to the dollar or the US dollar being the primary reserve currency, and that it would be the only currency that would be backed by gold. So they decided now the dollar should be the only currency that is backed by gold. And this was known as the Bretton Woods system. That was in 1944. Of course, now you are getting excited. So in 1971, the US declared. So now the US decided now it would no longer exchange gold for US dollar. So that was a big mistake, but it happened. Held in the foreign reserve. This marked the end of the Bretton Woods system. So it was this breakdown of the Bretton Woods system that led to the most globally acceptance of floating foreign exchange rates in 1976. So this, of course, was the birth of the foreign currency exchange market, although it did not become widely electronically traded until the mid-90s. So that is what happened. Odell, welcome, though you're a bit late, but welcome. So basically, my point was on gold. So there was the gold standard, then there was the Bretton Woods. So the gold standard was paper currency of all the world was supposed to be backed by gold, but then the supply for gold was low. It was very, very hard to keep track or be able to always have gold with you. Then, of course, the Bretton Woods came around 1941. That means the US dollar was supposed to be the only one that was supposed to be backed by gold. And then, of course, it was also abolished. And now the fixed exchange rates, whatever you see here is the bid and ask. When you go to the bank, when you go to the bureau, you're always seeing those exchange rates, or the birth of the Forex is where now it was established. So on gold, you can see on H1, that is on 1 hour, on 4 hours, even on D1. Let's just use 4 hours for better explanation. You can see since May. Let's even go since March. Or let's just go since April, or at least, yeah, you can see it's been on a rise. It's been on a rise. And as at the moment, I think it's trading at, you can see on my screen, it's trading at 1812. So it hit the 1800 mark yesterday. And it's really, really still going up. And the reason it's really going up is because, of course, this is the only place or the main safer haven that investors are looking at to price for long term, because you're looking at a point where you put money 10 years later, if you had $10,000, 10 years later, do you think you still find the 10,000? Of course, inflation, of course, the value will have gone down. Of course, there are factors, of course, interest rates, of course, it will be low because that is money or fiat money. We call fiat currency or the paper currency. So, and that's why the gold has been really rising because of this whole COVID situation. Most businesses ahead have gone down, others have gone bankrupt. And basically, there has been a lot of pressure. Workers are losing jobs. I think unemployment claims hit 40 million. I'm going to update you guys, but I think it still stands at around 40 million workers in the US. So basically, all this chaos happening in terms of turmoil, when this happens, always, even in 2008, I showed you the graph on monthly chart. gold is always the main place where guys run to. So it's important to know that gold. And then there's also silver. Silver, I think they operate more or less with the same chart. Let me just add silver. Silver is XAA. Yeah, so here is silver XAG. So silver is at 18, but I think the chart should more or less likely be the same. Yeah, you can see silver, it's on its all-time high. I'm trading gold and silver, and I'm telling you guys, it's really so much fun when you really understand how these commodities work, because it's so much. These are thrill. You can't leave the screen. You always want to know current affairs, what is happening. So let's go back to the calendar. So at least I hope you guys have I've just hinted a little bit of the interest rates, but we are going to be dealing with them when we come to fundamental analysis. So I'll be introducing fundamental and technical analysis next week, plus sentiment analysis. But I just needed to know what is happening. So nothing, it was unchanged on Tuesday 7th, Audi, the rates were unchanged. And I don't think there'll be any times they won't change anytime soon, because they can't hike, they can't do anything until everything comes back to normalcy, until demand comes back up and guys are like, now we can start buying, now we can start investing, now we can start doing all this. So on Wednesday, the yellow ones, they are low impact, so I don't pay much attention. Or the orange is also medium impact, but the red, the ones that you can see are marked in red, is the very high impact, means there'll be a very high impact. So that was on Tuesday. Then yesterday, there was crude oil inventories. So I'm going also to send on the group what the crude oil inventories are, what they represent, and the graph and the charts. I'm going to send that. So then on Thursday, now that is today, I'm also seeing we have Euro group meetings. So all the finance chiefs of the Euro or the banks or the countries in Europe, they're coming together to discuss the financial situation, to discuss how much they will pump in the economy for post-COVID, basically after us trying to deal or basically be able to come back to terms with life after COVID. It's not gone yet, but business has to keep running, because the economy is what is able to run in the country. So we also have a little bit of unemployment increase, though not high impact. You can see the orange ones, they're medium impact. So we have to wait at least by the end of the day to get the report of what they were talking about. So I'll also maybe send a little bit of that analysis. Then, of course, tomorrow we have CAD, employment change and unemployment rate. So we'll be able to see how many jobs were lost or how many jobs were created. Basically, that's what employment rate and unemployment change means. So all these terms, especially on the fundamental analysis, we'll be learning them. They are all of them in the curriculum or in the book. All of them, they are there. So, but it's good we'll be learning them slowly by slowly. Also, it's good we go back to the chart and see what has been the biggest move. The biggest move, of course, has been silver on H1. Let me go back to H1. Silver and gold really has moved. Let's also calculate how many pips they have moved. Control G. So this is silver, for example. Let me add, when you add the separators, so you can see what I've done. You right click, then you go to properties, then you add common, then around here you add the separators. So this is since Monday. I want to see since Monday. Monday was 6th. So since 6th was here. So you can see what happened on the weekend. There was a big pull. So these were the market makers coming for stop losses and all that. That's why this big candle is like this. But since Monday now, the market started rising. So this became our support, our main support. So we can at least get it from here. Tuesday, that is Tuesday up to today. Oh my God, it has moved almost 92 or 93 pips, almost 100 pips, which is quite good. So if you got this buy, this was a good move. It's still going up because you can see our moving average here is 200. So, and I told you, this is 200 period moving average. It's the main, even the big guys, they use it. Whether I'm using a 1 hour or 4 hour chart, or even monthly or weekly or whatever, 200 is usually the mother of all moving averages. Then we go to gold. Gold, let's see gold, what has been happening. A minute. So Control G again. Then we go to 1 hour because I want to know since Monday how far it has gone. So again, I add the separators here like that, and then I can track it. So this was Tuesday. So 6th, when is 6th? So this is Thursday, Wednesday, Tuesday, Monday. So Monday was here. So I believe there wasn't much move on Monday. So this was our lowest. So now this will act as our main support. So I can see it has moved, wow, almost 400, almost 4 or 5 pips. The gold really moves. So I'll let you know, at least gold moves. Now we look at the dollar. Now, because there's something we'll call intermarket correlation. Now the dollar, now you can see the opposite happened. So this is the USD index, or basically represents anything with dollar as the base. That includes USD chef, USDN, and the rest. So you can see Thursday, Wednesday, Tuesday, Monday. So I'm seeing the dollar has been losing since Monday. And is Monday around here? Monday. No, Monday was here, 6th, yeah, since here. So this will act as our main minute 11/6/06. Yeah, Monday. So this is Thursday. No, oh, this is H4. Sorry, guys. Let's go back to H1. Okay, this is H1 now. So on H1, where Monday is here, yeah, Monday, Tuesday, Wednesday, Thursday. So you can see since Monday, the dollar lost. It has lost almost 101 pips. So if gold is almost gaining, dollar most likely will be losing because they correlate. We can also go to Euro USD. I think Euro USD has been ranging, or yeah, you can see what it's been doing. So Euro USD this week, what has it been doing? So this is my Thursday, Wednesday, Tuesday, Monday. So Euro USD has been gaining. So this was also a good buy. I think at least up to here. It's also 107 pips, and it has gained almost 122 pips. So Euro USD or Euro, the Euro has gained. Of course, the reopenings, most of them are happening this week. Most of Europe, I think even the States, the lockdowns are easing, and guys are trying to come to terms with how do we operate business with the situation on ground with COVID-19. So that's why, of course, Euro. There was also, I think, around 750 or 800 billion dollars that was pumped in the economy. So that also was a big move. So that's why the Euro has been gaining. And I think the Euro might gain for quite a while. But on H4, it's still ranging. These are my main support and resistance. You can see this is my main resistance up here and my main support down here. I use H4 because H4 goes weekly. I can be able to track the pair weekly. So I'm still bullish on the Euro, but I'll have to wait. This is on D1, so you can see what happened. Went up, then shot down. Then on weekly, yeah, you can see on weekly, I think it's still strong, but then it has to break. You can see down here, the moving average, the blue line, this blue line, for it to completely be safe, it has to completely break this moving average for it at least to say, for us to say at least it's be able. And then that will only happen if, of course, if we see the rates of the cases going down and businesses trying to reduce or trying to come back to normalcy. So that is the Euro USD. I've also touched gold, silver, dollar, unless there's any other pair. You guys, oh, let's also check the future. You remember we said SPX 500 represents the actual value of the stock market of the US, or the Fortune 500 companies, their value and how they are traded in the stock market. So SPX 500 has also been gaining. You can see, and the sell-off was here, I think. This was the sell-off, H4. When was this? So this was 10th. So this sell-off was caused by the spikes. You know, the cases were rising again in some states when they were doing the reopening, and of course the virus fears caused the sell-off. But when you go to D1, I'm tracking it with D1 because D1 is daily. And if I was to add up the separators again, just give me a moment. Let me add them. So I can be able to track how far it's going. So the sell-off happened around February. You can see that was 20th 02 2020. That was around 20th February. That's when the sell-off happened. Then the lockdown happened around March. So that's why the big sell-off happened, because there was no demand. Oil almost was trading at negative. I think it went up to minus 37. And then now when demand opens, or when the countries reopen, airlines, I think they are, most of them, even ours, will be reopening by 1st August. So when they reopen, the cars come back to the road, oil, of course, demand for oil will go up. So when that happens, of course, the prices will start going up, because we are creating demand. So the governments of all over the world were like, okay, COVID happened, we have deaths, we have the situation of 2020, and all these jobs have been lost, people and all that. But now we have to keep moving. You know, it's a fight, it's a war with COVID or with the virus. We have to keep moving. And that's why at least we can be able, so you can see at least there have been some good steady recovery. So that's on SPX 500. Also, we can also, there's a lot of trade war happening, Beijing and Washington, that is US and China. You can see there's been a lot of trade war. So I'm also tracking the USD and the yuan. This is USD and the Chinese yuan. So I'm also tracking all the geopolitics, everything they're doing. There was the issue with Hong Kong. Those ones we are going to touch with them later on. So I think that can be good for today. So today, at least we have learned on margin trading. So, and I've been able to explain. So mostly today, I just needed us to learn a little bit of margin. I've also showed you a little analysis on gold, silver, the dollar, the euro USD. I won't touch the rest, but anything with the dollar, if it's going down, the opposite is going up, because as you can see, for example, Aussie and New Zealand. Let's go to Aussie. That's the Aussie pair, that's Australia. So you can see it's been gaining. If you go to so basically you can see anything that is quote, the USD is quote on the other side. We call them the anti-dollars. So anti-dollars basically is anything when the dollar is on the quote currency. Most of them has been on a rise. Let's also check the New Zealand and what it's been doing. Just 1 minute before we call it a day. So the New Zealand is here. I believe it's also been on a rise. So yeah, you can see it's also been a rise. I think still have a buy, still running. So the dollar, of course, we check USD chef also and USDN. So most of them on H1, you can see they've been falling or they have been losing. So USD CAD, we have been able to see USD CAD, the same case. You can see it's really fallen. Then eventually, let's look at USDN. USDN is also a popular pair. So USDN also, it has crossed, it lost. I think this was yesterday, and then this was Wednesday, and then this was Tuesday, and this was Monday. So Monday was flat, it gained, then it lost. There was consolidation. Yeah, I'm seeing we have, okay, I will zoom in later. It's okay, good. Questions on support and resistance, no problem. So guys, any questions? So I believe, at least for today, we have tackled margin trading. Unless we have any other questions, you can chat me. I believe we are all on the WhatsApp group. So the WhatsApp group is basically to help you guys at least be at par with everyone else. So this lesson was very important, and I've also made a recording. So I'm hoping this recording and also the one for last time, I'll be able to upload them online and share the link for the guys who are not able to attend the class or the Zoom class. So unless we have any questions, I think we can call it a day for today. So do we have any questions, guys? Any questions? Anything? Any addition? You can text, you can raise your hand. Just a question, where is the Audi USD heading to? So I have one question. So Audi USD, we have seen it's heading up. So this is Audi USD here. So what you do, you just track the price of what gold is doing, because if you're able to track what gold is doing, you'll be able to see, you can see. So our USD is here, we are at 0.06. So this is H1. Then I've also added oscillators, but I'll be introducing you to technical trading or technical analysis from next week. I hope Tuesday we'll have also this training, so that at least can be able to be at par with the rest. So this is H1, so it's been going up. So our USD, look at the curve, look at this beautiful smooth curve. So basically, when the candles are above, you can see the candles are all above the moving average 200. That means the price has been on a steady rise. Then also, it's good to check also on something we call multiple time frame, but it will depend also with what type of a trader you are. So that is D1, but mostly let's focus on H1 and H4 for the time being, because these are usually where most traders fall under. So Audi USD, I can see it's been on a steady rise, and I don't think this will change. So the more the reopenings happen and the good things, also Audi, they have managed to reduce their rates. So I believe, I don't think this trend will be changing anytime soon. So any other question, guys? So that is AUSI. So AUSI, I think it should remain like this for some time. So, but will be checking, because we usually track all these pairs on a weekly basis, depending with the news and what is happening. But AUSI has been on a steady rise, so I don't think there will be any much change there. So, okay, you're welcome. Mr. Clifford, you're welcome. So we'll be doing analysis, but I'll be concentrating mostly on the majors, anything with the dollar, gold, and but I can also do the rest, even the futures. So depending with whatever you want. So, but the major ones usually are anything with the gold. I'm not gold, anything with the dollar, the majors, anything Aussie, New Zealand, euro, dollar, pound also. Let's check what has been happening to pound before we wind up. Let's check. Has it been gaining? Oh my God, pound really gained. Huh? You can see, guys. I think pound gained. Yeah, pound has been gaining. So this has been pound. And let's check it for this week. So I also love pound. Pound is a good one. If you're able to understand how it operates, it's usually, yeah, you can see this is this week from here to here. Then on H1, yeah, you can see this is today, yesterday, Wednesday, Tuesday, and Monday. So Monday, 6th July was around, so was here. Yeah, this was 6th July. So started on the rise. So this is what I was telling you guys. You can be able at least to make even 100 pips. So you can see this was the pound. Pound has hit almost 180 pips at least for this week. So we'll be doing analysis. That's why it's important for us to come for the Tuesday class, because on Tuesday we are able to analyze Monday, and then we will be able to see Wednesday and Thursday, so that by Friday when the markets are closing, at least we can be able to see what happened for this week. So please, guys, I would really urge you at least to make it also for the Tuesday class, because we'll be doing a lot of practical analysis. We'll be doing more of these webinars. I'm seeing someone is coming in and we are almost done, but it's okay. So I'd advise you guys, please avail time. It's just an hour. We started at Zine exactly at 10. This is 11:19. That's almost 1 hour and 20 minutes. So kindly, guys, avail, because this is very helpful. I have a lot of content. I have a lot of information, and I've been in the markets for at least the last 10 years. And basically, I understand more on the fundamental, technical, and sentiment, and basically also the entries and exits for yourself or for wherever you're trading. Another thing, we shared some book there. There's a book called 17 Strategies. You need to go and understand your time frame. It's on page 145, I think, 145, 150. Understand your time frame. Are you better based as a day trader, scalper, mechanical trader, swing trader? What kind of time frame? What are you comfortable with? Are you comfortable with trading M30? For me, I'm usually more comfortable in checking H1 and H4 because I fall more on a swing or day swing. If I have, because I love holding and making more pips at the end of the day. So I'd really urge you guys, try and make time. This is very, very important. At least get the knowledge, get the skill. Let's make those pips, let's make those dollars, and at least we'll be all good to go. So do we have any more questions? I don't think we have any more questions. So guys, with that, I think we can call it a day for today. Thanks guys, at least for availing yourself. And unless there's anything else, I'll call it a day for today. So do you have any more questions, any addition? So you can also on WhatsApp, you can always drop us a message, tell us how the trainings are. Are you learning? Are you growing? I would really love to hear your feedback. So that at least we improve more. Oh, we have a new message. 1 minute. Oh, he's coming in right now. So I'd love to hear your feedback. I'd love to hear what you guys think. We'll be doing more of these webinars and posting the videos online so that at least you guys can be able to always be at par. So any questions? So I don't think we have any questions. So I think without much further ado, I'll call it a day for today. And thank you guys for participating. Thank you guys for availing. So until next time, that is on Tuesday at 10 a.m. Please guys, keep time. Thank you and enjoy your day and also your weekend. Thank you and have a lovely day. Goodbye. Thank you.